Look, I need to show you something that's happening right now in the gold market, something that most people are completely missing. And if you're holding gold, or you've been thinking about it, this might be the most important thing you hear all year. Because after years of waiting, after years of watching the price bounce around, after years of people saying gold is dead or gold is just sitting there doing nothing, we're finally seeing something different. We're seeing gold holders enter what I call the winning zone. And I'm going to show you exactly what that means and why it matters so much right now. Let me start with a story. Back in the early 2000s, there was a group of investors who bought gold around $400 an ounce, and for a while nothing happened. The price moved up a little, moved down a little. People started questioning whether they'd made the right decision. Some of them sold. They got impatient. They moved on to other things. But the ones who held on, they watched gold climb to $800, then $1,200. Then it touched $1,900 by 2011. Those patient holders didn't just win, they absolutely crushed it. They multiplied their money several times over while most people were chasing tech stocks and real estate. Now here's what's fascinating. We're seeing the exact same setup today, except this time, the fundamentals are even stronger. The catalysts are even more powerful, and the potential upside is even bigger. Let me show you what I mean. Gold recently broke through $4,000 an ounce. Think about that for a second. $4,000. That's not just a round number. That's a psychological barrier that the market has been testing and retesting. And when gold finally smashed through it, something changed. The entire dynamic of the market shifted. But here's what most people don't understand. That $4,000 level isn't the destination. It's the starting line. It's the entry point into what technical analysts call the acceleration phase. It's where gold stops grinding higher and starts running. And the data we're seeing right now suggests we're at the very beginning of that run. Let me walk you through what's actually happening behind the scenes, because this isn't just about one price level. This is about multiple forces converging at the same time, creating a perfect storm for gold prices. First, let's talk about central banks. Now, you've probably heard that central banks are buying gold, but do you understand the scale of what's happening? We're not talking about small purchases here and there. We're talking about the fourth consecutive year of massive record-breaking accumulation. Central banks bought over 1,000 tons of gold last year. 1,000 tons. To put that in perspective, that's more gold than most countries produce in an entire year, and they're not slowing down. They're accelerating. Month after month, we see the same pattern. China buying, Russia buying, India buying, Turkey buying, Poland buying. Even countries you wouldn't expect are loading up on gold. Why? Because they see something coming. They understand that the current monetary system is under stress. They know that holding dollars, holding euros, holding any fiat currency long-term is a losing game. So they're diversifying, they're protecting themselves, and they're doing it with gold. Now think about what this means for the market. When central banks buy gold, they're not day traders. They're not flipping it next week for a quick profit. They're locking it away in vaults. They're taking supply off the market permanently. And when you have that kind of sustained buying pressure, combined with limited supply, prices have nowhere to go but up. But it's not just central banks. Let's talk about what's happening with institutional investors, because this is where things get really interesting. For years, big money was skeptical of gold. They called it a barbarous relic. They said it doesn't produce cash flow, doesn't pay dividends, just sits there. But something changed. When gold started breaking records, when it pushed past 3,000, then 3,500, then 4,000, the institutions started paying attention. And now they're piling in. Gold ETFs are seeing massive inflows. Hedge funds are taking positions. Family offices are allocating serious capital. These aren't retail investors buying a few coins. These are billion-dollar funds moving hundreds of millions into gold positions. Why the sudden shift? Because they're looking at the same data you and I can see. They're looking at government debt levels that are completely unsustainable. They're looking at central banks that have no choice but to keep printing money. They're looking at geopolitical tensions that keep escalating. And they're realizing that gold isn't just an inflation hedge anymore. It's a survival asset. Let me give you a specific example. There's a major investment bank that recently put out a forecast. They're projecting gold could hit $5,100 an ounce. $5,100. Now, you might think that sounds crazy. You might think that's too optimistic. But here's the thing. This same bank was conservative on gold for years. They were the ones saying it would stay range-bound, that it wouldn't break out. And now they're completely reversing their position. What changed their mind? The data, the fundamentals, the realization that we're not in a normal market cycle anymore. We're in something different, something bigger. Now let me show you another piece of this puzzle. Let's talk about supply and demand dynamics, because this is where the winning zone concept really comes into focus. Gold production is essentially flat. The easy gold has been mined. The big discoveries happened decades ago. Today, mining companies are working harder and spending more to extract less gold. Production costs are rising, new projects are taking longer to develop, and the overall supply growth is minimal at best. Meanwhile, demand is exploding. You've got central banks buying at record levels, you've got institutions allocating capital, you've got retail investors in Asia, particularly China and India, buying physical gold like never before. You've got industrial demand from technology and manufacturing, and you've got investors around the world looking for safe havens as uncertainty increases. So you have flat supply and surging demand. Economics 101 tells you what happens next. Prices rise, and they don't just rise a little. They rise significantly. They rise until demand cools off or supply increases. And right now, neither of those things is happening. But here's where it gets even more interesting. Let's talk about the paper gold market versus the physical gold market, because there's a disconnect happening that most people don't see. The paper gold market, the futures contracts, the derivatives, the ETFs, that market is huge. It's worth trillions of dollars. But here's the problem. Most of that paper gold isn't backed by physical metal. It's leveraged. It's fractional. For every ounce of physical gold in a vault, there might be 10 or 20 or even 50 claims on that same ounce. This works fine when everyone's calm, when the market is stable. But what happens when people start demanding physical delivery? What happens when investors say, I don't want a paper promise, I want the actual metal? That's when the system breaks. That's when prices explode. And we're starting to see signs of stress. Physical premiums are rising. Delivery delays are increasing. Refineries are running at full capacity. The spread between paper prices and physical prices is widening. These are all warning signs that the paper market is getting stretched, that the leverage is becoming unsustainable. When that breaks, and I believe it will, we're going to see a price spike that makes the current rally look small, because suddenly, all those paper claims are going to try to convert to physical metal, and there simply isn't enough physical gold to satisfy that demand. Now let me pause here for a second because I want to mention something important. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without tax penalties, how the process works, what the rules are. Worth checking out if that's relevant to your situation. All right, back to where this is headed. Let's talk about historical parallels, because gold has been in winning zones before. And when we look at those periods, we can learn a lot about what might happen next. Go back to the 1970s. Gold started that decade at $35 an ounce. It was fixed at that price by the government. Then Nixon closed the gold window. He ended the dollar's convertibility to gold, and suddenly gold was free to find its real market price. What happened? It went from $35 to over $800 by 1980. That's more than a 20 times increase in less than 10 years. People who bought gold in the early 70s and held through the decade didn't just do well. They became wealthy. They preserved their purchasing power while inflation destroyed everyone else. But here's what's important. That move didn't happen in a straight line. Gold would rally, then consolidate. Rally, then pull back. Rally, then pause. And at each consolidation, people would say the move was over. They'd say gold had topped. They'd sell and move on. And then gold would break out again and leave them behind. The winners were the ones who understood the bigger picture, who saw that the fundamentals hadn't changed, who held through the volatility and the doubt and the consolidations. Those were the people who captured the full move. Now fast forward to the 2000s. Gold started that decade around $250 an ounce. And once again, most people ignored it. They were too busy with tech stocks and real estate. But a small group of investors saw what was coming. They saw the housing bubble building. They saw the debt accumulating. They saw the Fed keeping rates too low for too long. And they bought gold. At $300, at $400, at $500. And people laughed at them, called them gold bugs, said they were missing out on the real gains in stocks and real estate. Then 2008 happened. The financial crisis hit. Lehman Brothers collapsed. The banking system nearly imploded. And suddenly everyone wanted gold. The price shot from $700 to over $1,900 in just 3 years. Those patient holders who bought in the early 2000s, they multiplied their money several times over while everyone else was watching their portfolios get destroyed. Now here's why I'm telling you these stories. Because we're in a similar setup today, except the fundamentals are even more extreme. Government debt is higher than it's ever been. Central bank balance sheets are more bloated than ever. Geopolitical tensions are more severe. The monetary system is more fragile. And gold is telling us something. It's breaking out to new all-time highs. It's showing strength even when the dollar is strong. It's rallying even when real interest rates are positive. That's not normal. That's not how gold usually behaves. And it's telling us that something big is coming. Let me show you what the technical picture looks like, because the charts are confirming what the fundamentals are saying. Gold spent years building a base between $1,200 and $2,000. It was consolidating, digesting the previous gains, building energy for the next move. And then it broke out. It cleared $2,000 decisively, then $2,500, then $3,000. Each level that used to be resistance became support. And now we're above $4,000. We're in uncharted territory. There's no overhead resistance, no previous sellers to work through, just open air above us. And when you combine that technical setup with the fundamental drivers we talked about, you get a recipe for a sustained bull market. But here's what separates the winners from everyone else. It's not just about being in gold. It's about understanding where we are in the cycle. It's about recognizing that we're entering the acceleration phase, the winning zone. Think about it like this. In the early stages of a bull market, prices grind higher slowly. It's boring. It's frustrating. People lose patience. But that's when the smart money is accumulating. That's when the foundation is being built. Then you hit the middle stage. That's where we are now. Prices start moving faster. The gains become more noticeable. More people start paying attention. The momentum builds. This is the winning zone. This is where patient holders start seeing serious returns. And then there's the final stage, the blow-off top, where prices go parabolic, where everyone rushes in, where the gains happen so fast it feels unreal. That's coming. But we're not there yet. We're in the sweet spot, right before it. Now let me address something important. Some people look at gold above $4,000 and think they missed it. They think it's too late. They think the big gains already happened. But that's exactly what people said when gold hit $1,000, and $2,000, and $3,000. And they were wrong every time, because they were looking at the absolute price instead of the fundamentals. They were focused on where gold had been instead of where it was going. Here's the reality. If gold is going to $5,100, like some major banks are projecting, then buying at $4,000 is still getting in early. That's still a 25% gain. And if gold goes even higher, if it hits $6,000 or $7,000 or more, then $4,000 will look like a bargain. But it's not just about the price target. It's about what gold represents. It's about having an asset that holds its value when everything else is falling apart. It's about having insurance against monetary chaos. It's about having a store of wealth that governments can't print, can't devalue, can't confiscate with the stroke of a pen. Let me tell you about something that's happening right now that most people aren't talking about. The de-dollarization trend. Countries around the world are actively working to reduce their dependence on the US dollar. They're setting up alternative payment systems. They're trading in their own currencies. They're settling transactions in yuan, in rupees, in other currencies. Why does this matter for gold? Because for decades, the dollar's dominance has kept gold prices suppressed. When everyone needs dollars for international trade, when everyone holds dollars as reserves, that creates artificial demand for dollars and reduces demand for gold. But as that changes, as the dollar's role diminishes, gold becomes more important. It becomes the neutral reserve asset. The one thing that every country trusts. The one asset that isn't tied to any government or political system. And we're seeing this play out in real time. The BRICS nations, Brazil, Russia, India, China, South Africa, they're talking about creating a gold-backed currency. They're discussing using gold for trade settlement. They're moving away from the dollar system. And as they do, gold's role in the global monetary system is expanding. This isn't happening overnight. It's a gradual process, but the direction is clear, and the implications for gold prices are massive, Because if gold becomes the foundation of a new monetary system, if it becomes the settlement asset for international trade, the current price is going to look absurdly cheap. Now let's talk about inflation, because this is something everyone's feeling but not everyone understands. Official inflation numbers say prices are up 3 or 4%, but that's not what people experience in real life. Go to the grocery store, look at your rent, check your insurance premiums, look at healthcare costs. Real inflation, the inflation you actually pay, is much higher. And here's the thing, that inflation isn't going away. Governments are too deep in debt to stop spending. Central banks are trapped. If they raise rates too much, they crash the economy and bankrupt the government. If they keep rates low, inflation stays elevated. They're stuck between a rock and a hard place. So what happens? They choose the path of least resistance. They keep rates lower than they should be. They let inflation run. They slowly devalue the currency. And your purchasing power erodes year after year, unless you own gold. Because gold maintains its purchasing power over time. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 50 years ago, or 100 years ago. The number of dollars might change, but the real value stays constant. That's why gold holders are entering the winning zone, because they're protecting themselves from this slow-motion theft. They're preserving their wealth while everyone else is watching theirs evaporate. Let me give you another angle on this. Think about what's happening with government debt. The U.S. government is running trillion-dollar deficits every year. The total debt is over $30 trillion and climbing. Interest payments on that debt are becoming one of the largest budget items. How do you solve that problem? You can't tax your way out of it. The numbers are too big. You can't cut spending enough. Too many programs are politically untouchable. So what's left? You inflate your way out. You print money. You devalue the debt. You make those dollars worth less so the debt becomes easier to pay. And who gets hurt by that? Savers. People holding cash. People on fixed incomes. Anyone whose wealth is denominated in dollars. But gold holders? They're protected. Because as the currency devalues, gold's price in that currency rises. It's not that gold is becoming more valuable. It's that the currency is becoming less valuable. And gold is simply maintaining its real worth. This is why central banks are buying. This is why institutions are allocating. This is why smart money is moving into gold. They see what's coming. They understand the end game. And they're positioning themselves accordingly. Now, let me talk about something that might surprise you. Gold's performance during different economic scenarios. Because gold isn't just an inflation hedge. It's much more versatile than that. In an inflationary environment, gold obviously does well. We've talked about that. But gold also performs during deflation, during financial crises, during periods of negative real interest rates, during geopolitical instability, during currency crises. Gold is the ultimate all-weather asset. Why? Because gold is the anti-fragile asset. It doesn't depend on any government's promises. It doesn't rely on any company's earnings. It doesn't need the financial system to function properly. It just is. It has value because it's scarce, because it's durable, because humanity has valued it for thousands of years. And in times of uncertainty, in times when people question whether the system will hold together, that intrinsic value becomes incredibly important. That's when gold shines. That's when it outperforms everything else. Look at what happened during the 2008 crisis. Stocks crashed. Real estate crashed. Bonds from certain issuers became worthless. But gold held its value and then rallied to new highs. It was the safe haven, the asset people fled to when everything else was falling apart. We're setting up for something similar today, except the imbalances are bigger, the debt levels are higher, the risks are more severe. And when the next crisis hits, and it will hit, gold is going to be the asset everyone wants, and the price is going to reflect that demand. But here's the key insight. You don't want to wait until the crisis to buy gold, because by then, prices will have already moved. Premiums will be sky high. Physical metal will be hard to find. You want to position yourself before the crowd realizes what's happening. You want to be in the winning zone before everyone else tries to get there. Let me share one more story with you. There was an investor in the early 2000s who saw the housing bubble building. He knew it was unsustainable. He knew it would end badly. So he started buying gold. Not a little bit. A significant portion of his portfolio. His friends thought he was crazy. They were making money flipping houses. They were riding the real estate boom. They told him he was missing out, that he was being too conservative, that gold was a dead asset. He ignored them. He kept buying. And when 2008 hit, when the housing market collapsed, when his friends lost everything, his gold position saved him. Not only did he preserve his wealth, he actually grew it significantly. Because while everyone else was panicking and selling, he was calm. He was protected. He was in the winning zone. That's the power of positioning yourself correctly. That's the advantage of understanding the bigger picture. That's what separates people who build lasting wealth from people who chase trends and get wiped out. Now, where do we go from here? What's the path forward for gold prices? Based on everything we've discussed, the fundamentals, the technicals, the supply and demand dynamics, the monetary backdrop, I believe we're in the early stages of a major bull market. Not a short-term rally, not a quick pop, a sustained, multi-year move higher. Could we see pullbacks along the way? Absolutely. Gold doesn't go straight up. It never has. There will be consolidations. There will be corrections. There will be moments when it feels like the move is over. But those are buying opportunities. Those are chances to add to positions. Because the underlying drivers haven't changed. The key is to maintain perspective, to understand that we're in the winning zone, to recognize that the patient holders, the ones who can see past the short-term noise, are going to be the ones who capture the full move. Think about what gold at $6,000 would mean, or $7,000, or higher. Think about what that would do for your portfolio, for your wealth, for your financial security. And then ask yourself, are you positioned to benefit from that move? Or are you going to be one of the people watching from the sidelines, wishing you had acted when you had the chance? Because here's the truth. Opportunities like this don't come around often. We're living through a historic shift in the monetary system, a transition from one era to another, and gold is at the center of that transition. It's the asset that's going to preserve wealth through the chaos. The asset that's going to reward the people who understood what was happening and positioned themselves accordingly. The winning zone isn't about getting lucky. It's not about timing the market perfectly. It's about recognizing when the fundamentals are overwhelmingly in your favor, when the risk-reward is skewed heavily to the upside, when the smart money is moving in one direction and you have the opportunity to move with them. That's where we are right now with gold. The central banks are buying. The institutions are allocating. The supply-demand dynamics are tightening. The monetary system is under stress. The geopolitical risks are escalating. And gold is breaking out to new all-time highs. This is the setup. This is the moment. This is when gold holders transition from waiting to winning, from hoping to profiting, from questioning their decision to being validated by the market. So the question isn't whether gold is going higher. The data, the fundamentals, the historical precedents all point in the same direction. The question is whether you're going to be part of this move, whether you're going to position yourself in the winning zone, whether you're going to look back years from now and be glad you acted or regret that you didn't. Because one thing is certain, the monetary system as we know it is changing. The old rules don't apply anymore. The assumptions that worked for decades are breaking down. And in that environment, gold isn't just an investment. It's a necessity. It's the foundation of a sound financial strategy. It's the asset that's going to separate the winners from everyone else. The winning zone is here, the opportunity is now, and the choice is yours.